In 2008, the world economy almost died. Banks collapsed. Millions lost their homes, their jobs, their savings, and the world swore. Never again. We passed laws. We hired regulators. We put the banks under a microscope, and we have been staring at them ever since. But here's the problem. For 18 years, everyone has been watching the banks, while the risk quietly moved next door into a market most people have never even heard of. A market that grew from $300 billion to over $3 trillion, with a fraction of the rules and almost none of the attention. And in 2026, that market has started to crack. Funds are locking their doors, frauds are surfacing, and regulators are using a phrase they haven't used since 2008: a systematic risk. This is the story of the shadow banking system and why the next financial crisis probably won't start in a bank at all. Hey everyone, my name is Arora. Hope you're doing well. Let's step into the shadow. First, the basics in plain language, like always. Imagine you run a medium sized company and you need to borrow $500 million to grow. Traditionally, you would go to the bank. But since 2008, banks often say no to companies like yours. Too risky, too much paperwork, the regulations won't allow it. So you walk next door to a private credit fund. This is simply a giant pool of money collected from pension funds, insurance companies, and wealthy investors, and that lends directly to companies, no banks involved. That's it. That's private credit, loans made by investment funds instead of banks. Why do companies use it? Because the fund says yes when the bank says no, faster, with fewer questions. Why do investors love it? Because these loans charge higher interest, which means higher returns. And because these lenders are not banks, they escape most of the banking rules. No bank style inspections, no requirement to publicly report what their loans are really worth. That's why economists call this world the shadow banking system. It does what banks do, but in the dark. Now, here's the number that should make you sit up. In 2010, this market was around $300 billion. Today's, it's over $3 trillion. It grew roughly tenfold, 5 times bigger than it was at the last financial crisis. And it has never been tested by the real economic storm until now. Here is the part of the story that historians will love. The shadow banking system isn't an accident. It exists because of 2008. After the crash, governments passed strict new rules on banks, like they have to hold more emergency cash, take fewer risks, submit to constant inspections. The rules worked. Banks really are safer today than it was before. But think about what actually happened. The risky lending didn't stop. The demand was still there. Companies still wanted loans. Investors still wanted returns. The risk didn't die. It moved out of the regulated glass towers into the unregulated building next door. It's like a city banning smoking indoors and declaring victory while everyone smokes in the alley outside. The smoke didn't disappear, it just moved where the inspectors don't go. One of the America's most famous bond investor, Jeffrey Gundlach, looked at all this and compared the hype around private credit to the conditions before the subprime mortgage crisis, the exact disease that caused 2008. In the late 2025, the first symptoms appeared. Let me show you what cracking looks like in the shadow world. In a normal bank crisis, you see people making a queue outside the branches to pull out their money. In the shadow system, it looks like this. First, investors rush for the exits. When you invest in a fund, asking for your money back is called redemption. In early 2026, redemption requests exploded. Blackstone's flagship private credit fund, $82 billion, one of the biggest in the world, was hit with $6.5 billion in exit requests in a single quarter. Blackstone executives put in $400 million of their own money to just steady the ship. Ask yourself, if everything is fine, why was that necessary? Number two, the funds locked the doors. BlackRock Limited withdrawals from a $26 billion lending fund after exit requests hit nearly double its allowed cap. Blue Owl, another giant, froze withdrawals from one of its retail funds entirely. In finance speak, this is called gating, literally putting a gate between investors and their money. A bank run in a slow motion, happening behind closed doors with no cues for the cameras to film. Number third, default search. A default is when a borrower simply can't pay. Default rates in private credit fund have climbed to record territory, around 6% by Fitch measures, with some measures even higher. For a market that spent a decade bragging it was safer than banks, that's a very loud alarm. And then the tide went out and revealed what was underneath. Okay, quick explainer. When you borrow big money, you pledge collateral, something valuable the lender can seize if you don't pay, like leaving your watch at a pawn shop. In September 2025, two private credit-backed companies collapsed within weeks of each other and opened everyone's eyes. First Brand, a car parts company, allegedly pledged the same collateral to multiple lenders at the same time. Imagine you pawning your watch at 5 different shops at once, collecting money from each one, and all 5 believe they own it. That's the accusations. And nobody noticed for years, because in the shadow system, lenders can't easily see what other lenders are holding. Tricolor, a subprime auto lender, went down around the same time. 2 collapses don't make a crisis, but they revealed a disease. Opacity, a system so dark that even the professionals inside it can't see what's real. In 2008, the rot hit inside complicated mortgage bonds nobody could read. In 2026, it hit inside private loans nobody can see. And here's the stat that turns this from a few bad apples into something bigger. The IMF found that 40% of the private credit borrowers had a negative cash flow at the start of the year. Negative cash flow means the business spends more than it earns. It survives only as long as the lender keeps extending the loan. Wall Street even has a nickname for this game: extend and pretend. Extend the loan, pretend everything is fine, push the problem into the next year. It works right up until the year it doesn't. Now, here's the angle almost nobody covers, and it's the scariest part of this entire story. Remember the whole point of this system. The risk left the banks. Banks are safe now. That's official story, right? Except, follow the money. Who do you think lends money to these shadow lenders themselves? The banks. Since 2010, bank lending to these shadow institutions has grown from 56 billion to nearly 1.5 trillion, an increase of over 2,500%. For comparison, mortgage lending grew only 39% in the same period. Nothing else comes close. Count total loans plus promises, and US banks' exposure to the shadow system reaches about $2.55 trillion, which is more than the entire banking industry's equity. In plain words, banks have lent the shadow world more than its own safety cushion is worth. Analysts call this leverage on leverage. Borrowed money lending borrowed money. The banks didn't escape the risk. They are financing it through a tunnel, one layer removed, where it's harder to see. This is why America's own bank regulators, the FDIC, named this interconnection a primary systematic risk in 2026. Systematic is the heaviest word in finance. It means if this corner falls, it doesn't fall alone. And what's the spark that could light it? Here's the twist connecting to this my AI videos. A huge share of these private loans in some portfolio, around 40%, went to mid-sized software companies, the exact business that AI is now eating alone. The shadow system biggest bet is on the companies AI is replacing. Ex Goldman Sachs CEO Lloyd Blankfeet put in one sentence: just a spark may light private credit on fire. Now, the news chapter, the one that makes the veterans of .com crash rub their eyes. Who do you think the hottest borrowers in the shadow system today? AI companies. Debt for AI data centers passed $200 billion in 2025 alone, with projections of up to $300 billion more this year. Private credit funds are racing each other to lend to this AI boom. One company tells the entire story. CoreWeave started as a small crypto mining outfit. Then in 2023, it did something that hadn't been done in financial history. It borrowed $2.3 billion using computer chips as collateral. Not building, not a factory, NVIDIA GPUs. The graphic chips that power AI, pledged like watch at a pawn shop. Much of it from the same shadow lenders we have talked about, Blackstone among them. So you see the problem. Remember, collateral only protects the lender if it's hold its value. A building lasts 50 years. A GPU is outdated in 2 or 3 years. And rental prices for older AI chips have already crashed 50 to 70%. Some of these loans charge around 11% interest, with repayments starting in 2026, just as the chips backing them lose their value. Analysts call it the GPU debt treadmill. You must constantly borrow more to buy newer chips to replace the collateral that is melting under you. And the circle gets even stranger. NVIDIA, the company selling the chips, owns a stake in CoreWeave, its own customer, and has reportedly offered informal guarantees on chip values to keep the loans flowing. The seller propping up the buyer's borrowing to buy the seller's product. It's financial history. Financial historians have a term for when the circle breaks a bubble. Here's the number that should stop you cold. In 2026, the AI infrastructure industry earned around $60 billion in revenue against $400 billion in spending nearly 7 times what it earns on borrowed money, as secured by melting collateral. If this feels familiar to you, it should. In 1999, the telecom companies borrowed fortunes to lay fiber optic cable for an internet future that was real, but arrived years too late to save them. The internet won. The Global Crossing and the WorldCom still went bankrupt, and their lenders burned. The technology succeeded, and the borrowers collapsing can both happen at the same time. The first lawsuits against CoreWeave and Oracle bondholders have already been filed. The dot-com bubble popped in the stock market in daylight. If this one pops, it pops in the shadow where nobody can see how deep it goes. Okay, if you have watched this far, thinking sad for the billionaires, but this isn't my problem. This section is for you. In the middle of all these cracks, regulators in the US gave the green light for private credit to be sold into retirement accounts like 401ks, a market worth around $13 trillion of ordinary people's pensions savings. Europe opened something similar doors with their own fund rules. Think about the timing. The industry's traditional investors, the big institutions, are asking for their money back. And the exact moment the the door opened to the savings of teachers, nurses, and office workers. The generous rating. Regular people finally get access to the returns that were reserved for the rich. The cynical rating, the smart money is heading for the exit, and your pension is being invited to replace it. I will let you decide which rating fits, but remember one feature of this market. When trouble comes, funds can gate, lock the doors. Your bank deposit is guaranteed by the government, but your private credit fund is not. Now, you know my role on this channel. I give you both sides, even when one side makes the better thumbnail. So here's the honest argument. Many serious analysts says these fears are overblown and they have real points. Number 1, unlike bank deposits, most private credit money is locked in for years by contract. Investors legally can't all run overnight. The slow motion nature of shadow bank run is also a built-in break. Number 2, the big banks today hold far more emergency capital than in 2008. Stressed? Yes. Fragile like 2008? No. Number 3, money is still flowing into private credit. For every investor heading for the exit, new ones are coming in. That's not what collapse looks like yet. So no, this is not a prediction that world ends on Tuesday. 2008 didn't repeat because everyone was watching for an exact repeat. The lesson of financial history is different. The next crisis always comes from where nobody is looking. And right now, this is the biggest, darkest, least watched corner of the financial world, being stress tested for the first time in its life, with pension money walking in the door. That's not a panic, that's just worth watching closely. Here's the 5 signals that tell you whether this heals or breaks. Number 1, more gates. Every new fund that limits withdrawals is a confidence crack. Watch for the word redemptions in financial news. Number 2, more first brands. Each new fraud discovered means the opacity is worse than admitted. Number 3, default rates. If they push meaningfully past current records, extend and pretend is failing. Number 4, a bank taking visible damage. The moment losses jump through the tunnel from the shadow world into a regulated bank, that's the 2008 eco turning real. Number 5, the pension flows. If retirement money floods in while institutions flow out, remember what that pattern means in every bubble in history. 18 years ago, the world promised never again and built a fortress around the banks. The fortress worked, but finance is like a water. Block its path and it doesn't stop. It flows around the wall. $3 trillion found the gap. And here's the truth nobody wants to say it loud. 2008 was never actually really fixed. It was relocated. The same hunger for risky returns, the same hidden dangers, the same blind spots, just moved to the place with fewer lights and fewer cameras. We didn't end the game, we just changed the address. In 2008, the warning signs were everywhere. Rising defaults, hidden frauds, complicated products nobody understood. Everyone saw them. Almost nobody acted. Afterwards, the world asked the same question. How did nobody see it coming? They did say it. They just weren't looking where it lived. So no, I can't tell you when the shadow cracks or even if it will. Nobody honestly can, but I can tell you this. When the next crisis comes, it won't announce itself on the evening news. It will come from a market you were never been told about, through a door you didn't know existed. Now you know the market. Now you know the door. Don't look away. If you like this video, please do not forget to like and subscribe. My name is Arora. I will see you in the next one.